But let me welcome on board Vinay Jaising as well and ask him about what he's making of the market. Vinay, hi, good afternoon. What a roller coaster this entire week has been. But finally, we are back to where we started off the week. What do you think the texture of the market is going to look like in the days to come as we get thick into earnings?
So I think a couple of things are important which the market is looking for. First is the earnings will relatively beat market expectations more than otherwise because you've seen already the loan book growth for the country has been a robust 16-17%, which means consumption should tick the box at least on the top line. The sales part of it should be great. Those companies, depending on commodities as raw material, will see a margin reduction. But four sectors which should be driven as far as earnings are concerned are telcos, NBFCs because of the consumption growth story, capital goods because of the good export orders, and domestic pharma. Net, add that to even the larger banks. You should see the earnings being a robust 15 to 16%. The big fear is, will the war reiterate itself and will oil prices move from the 75 to 80, which is a very comfortable level for India today, notch up to the 95 to $100 levels, which would be a question mark. That's the only question mark, in the short term in my eyes. The two better things going for India in the last fortnight to, I would say, last 30 days have been FIIs have been back. If you look at what's happened in the last 15 days, though the month of June saw $5.5 billion of outflows, the last 10 days of June and whatever we've seen in July has seen almost $1.5 to $2 billion of inflows coming in FIIs in the equity space. In the debt space, in the last month and 10 days, since the government has announced G6 for FIIs not to having any withholding tax, we've seen another $6.5 billion come into the country. So the rupee has stabilized. So a lot more constructive today than what we would have been a month and a half ago.
Okay, that's the view coming in on the market. Vinay, hi, good afternoon. Now, for a while now, you've been more tilted towards the broader end of the market in terms of where the growth potential could be versus the larger caps. But now that geopolitical tensions are once again resurfacing, would that view still hold?
Yes, because our story was a lot more about where the earnings are coming from, right? So if the earnings are coming from the domestic capex story, we're going to buy the domestic capex story. If they're coming from defense, if they're coming from those companies getting orders from the Indian government, that's the space we want. And obviously, valuation plays a very big role there. If it's coming from Make in India story, wherein you're replacing global exports or you're becoming a big exporter for the world, we're going to look at those companies, even if they are PLIs, which have corrected. If it is for easing liquidity, and here you have a couple of large caps because NBFCs are big gainers of the easing liquidity in the country. So we would have large cap at 30-35% of our portfolio coming in there. And if it is the global AI ecosystem infrastructure where India is becoming a very important part of providing capex, be it in power equipment, be it in cables, be it in hot boxes, where the earnings growth are very robust. That's a space we would look at. So we are first targeting earnings growth, happens to be in mid and small cap. There are some large caps which are going pretty well, which are relatively cheap. We are looking at them as well. Return on capital employed is important and free cash flows. So we're finding them a lot more in mid and small. And I think that's where even FIs will probably look at, when they come back into the country.
Interesting. So, Vinay, what is the anticipation from the earnings this time around? Which sectors do you think would turn to positively surprise? And to begin with, what did you make of TCS's commentary?
So, as far as TCS were concerned, the commentary was a lot more robust than what the street expected. That's good news, though it is, only about 10 to 12% of the overall top line of the company. AI is growing pretty impressively. Their EBITDA margins, they expect that to inch up from 25 to 26%. Again, another good news. But here you're talking about a company wherein you're seeing the bottom line growth based on analysts, growing between anywhere between 8 and 10% or 6 and 8%. not higher in dollar terms. The currency would give them a little bit better fillip. Here you still have only 10% of the earnings which are growing at 14, 15%. So in the results were good. The outlook is relatively good, but for a very small part of their business, which is 15%. Overall, the valuations are very attractive. But since we are looking at not, flat movers, for us, the services space is where we are underweight. Though in IT, you also have AI-enabled names or those companies, which are giving you AI products which come in IT. I can't say we are underweight IT incrementally, but in the total services space, the large cap space, we think the earnings growth is largely behind you. To expect a 12 to 15% earnings growth in the next year to two is a little bit far away. But to expect, the stocks or the company's earnings to fall, I think that's also not there. So, somewhere between 5 to 12% would be the earnings growth. Very similar would be probably our expectation of what they would do in the process. So not very interesting for us. Where we think the numbers would be a lot better is in telcos, because you've seen the ARPUs inch up incrementally in telecom. When the ARPU inch up, virtually 70% of that straight away goes to the EBITDA, and more than 55% of that goes to the bottom line. And here we are seeing 30+% growth in earnings on a quarter-on-quarter basis. So all eyes there. NBFC space, where you're seeing 20+% top line growth, we're seeing more than a 22 to 25% bottom line growth. So good earnings driver there. Lots of capital good companies on a year-on-year. Will not be surprised if the top line grows between 15 and 20, and the bottom line again similar. I'm not talking about defense, because defense is going to be a relatively weak quarter, at least for the PSUs, wherein we are looking at a 10% top line and a bottom line growth. Finally, the pharmaceutical sector, especially domestic, that's where we're seeing a growth of somewhere close to 15 to 20% on the top line and similar on the bottom line. So this is where I think you'll have a broad-based earnings growth, which will, please the markets. You will have some pockets of pain because, let's say, auto or cement may have good top line, but EBITDA margins would be questioned and the PAT growth would be a little lower. But overall, we think, the market is in for more surprises on the earnings growth.
Surprises, hopefully on the positive side on the earnings growth. When
That's
earlier you did mention that you are positive on NBFCs on the back of consumption. How are you looking at consumption as a sector by itself, and how would you be playing a theme as broad as this one?
right. So our entire consumption bets are on the NBFCs and not on the consumption sector. Again, because of the classification of consumptions, you have PLIs also coming in consumption, so we would be betting on that. But the pure play consumer names, we are not as excited about because of their valuation. Having said that, they would be the street in terms of top line, in terms of numbers, and we won't be surprised if they get a 10 to 12% bottom line growth out there. But here we are looking at the NBFCs which are growing north of 20% on the bottom line in earnings, 15+% ROAS, and relatively low P's as well as price to books. So that's where we are playing our end of the consumption basket. Be it an NBFC is dealing with the housing finance space or overall NBFCs where you're getting the auto growth also come into the picture. We are pretty excited about that space.
Vinay, as an investor strategy, I mean, given the kind of recovery that we've seen from the March lows, and that's largely been about the mid and small caps, it's a different bull market out there when it comes to individual segments and even at an index level for that matter. From here, though, do you be sector agnostic? Do you get more stock specific? What kind of strategy would work?
So I think, the strategy which has always worked is look top down, look at what you're bullish on, and then go bottom up. Don't focus as much on sectors as you focus on individual stocks. So we would focus on this again. The big change from now to, let's say, March is in March, we were concerned on the currency because of the war. You had seen the dollar get a lot more appreciating. You saw 85.90 go to 95.96, and India was the worst performing currency. Interestingly, post June 12th, I can't say that the war is in because you've already seen issues come up. India, Taiwan, and Korea are the three best performing markets. So India's kind of come there, and the Indian Indian small cap and mid cap are giving you even more returns. What I would look at, again, going back to what I repeated earlier, is where are we seeing the earnings? Now, the difference is you're seeing liquidity being driven because of what the government has done on the debt market. So that's why NBFCs become a meaningful position for you, because if liquidity was a constraint or deposit growth was a constraint for consumption, that's behind you. If you were earlier playing dollar plays purely to get the advantage of exports, now you're going to play those dollar plays where you actually have meaningful big order books coming because of the AI infrastructure, and these are all bottom up ideas. That's how I would play it, right? Bottom up ideas where we're seeing good growth come in. That would be our focus areas.
Okay, bottom up is the way to go. On that note, Vinay, thank you so much for your time. So good to be speaking with you today, and thanks for sharing your views and your insights with our viewers. Thanks so much.
Thank you so much.